Most people think credit cards are just a convenient way to buy now and pay later. But for the middle class, they quietly turn into one of the biggest wealth traps of modern life. The trap isn't an accident, it is built into how interest, fees, and psychology are used to keep people paying for as long as possible. Every year, middle-class families lose thousands of dollars, not in obvious taxes, but in interest on their credit cards. In many countries, the average credit card interest rate has climbed above 20% per year, with some cards that actually carry a balance charging closer to 23–25%. At those levels, credit cards quietly become a machine that transfers money from ordinary households to banks, month after month, year after year. On the surface, the system looks simple: you swipe a card, you get what you want, and you pay later. Behind the scenes, credit card companies earn through three main streams: high interest on unpaid balances, late payment penalties, and transaction fees charged to merchants. Before I break down how banks trap people with credit cards and loans, hit subscribe so you don't miss what comes next and help the channel grow. Later in this video, I'll share a simple legal trick that can save you thousands in interest. Stick till the end, because you'll learn how to pay 0% interest even while making only the minimum payment. The real trap begins the moment you stop paying your full balance every month, because that is when high interest, compounding debt starts to grow in the background. Cards are designed to show a minimum payment that feels small and harmless. Paying that minimum gives a psychological feeling of progress, but in reality most of it goes toward interest, not your actual principal debt. This is why so many people keep paying for years, while their balance barely moves, even as the bank continues to collect a steady stream of income. Imagine you spend $1,000 on a card with an interest rate around 22%, and then only pay the minimum each month. That small minimum payment might keep the bank happy, but over time you can end up paying hundreds of extra dollars in interest and stay in debt for many years. Scale that up. In some countries, households with credit card debt owe around $9,000 on average. Over decades, the same logic appears in larger loans. With typical long-term mortgage rates, the total paid over 25–30 years can approach double the original price of the house once interest is included. When the asset is a car that loses value quickly, financing it at high interest turns a depreciating object into a long-term burden that often ends up costing far more than the car is worth. Missing a payment by even one day can trigger heavy late fees and sometimes a hike in your interest rate. Recovering from a single missed payment can take months of careful budgeting, and in the meantime your cost of borrowing may permanently increase. This extra pressure keeps people focused on survival, avoiding the next penalty instead of escaping the system altogether. For centuries, belief systems around the world looked at this pattern and sounded the alarm. Islam strictly forbids interest, arguing that earning profit without sharing risk leads to injustice and pushes borrowers into hardship. So Islamic finance uses profit sharing and asset-backed contracts. Early Christian and Jewish traditions also strongly discouraged or limited interest because they saw how it could trap the poor and middle classes in permanent dependence. Even today, some countries cap interest rates on consumer loans or promote interest-free and profit-sharing models. These systems are designed to stop lenders from making huge, risk-free profits, while ordinary people drown in long-term obligations. They recognize that when interest is unchecked, it stops being just a fee and becomes a tool of financial exploitation. Credit cards do not just rely on math, they rely on human psychology. Paying with a card does not feel like real spending, because there is no physical pain of handing over cash, so people are more likely to buy things they do not need or spend more than they planned. On top of that, the interface, smooth apps, tap-to-pay, and frictionless checkouts removes every small barrier that might make someone think twice. Rewards make the trap feel like a game you're winning. Cashback, air miles, and points look like free money, but these programs are carefully calculated so that most users pay far more in interest and fees than they receive in rewards. Banks know that dangling small benefits encourages higher spending and keeps people using cards instead of switching to safer habits. The richest people usually treat credit cards as a tool. They pay their balances in full every month and use rewards without paying interest. The poorest often cannot even qualify for large limits. The group that gets squeezed the hardest is the middle class. Families who feel they are doing okay but rely on loans and cards to handle rising living costs, emergencies, tuition fees, weddings, or medical bills. I'm going to show you a simple trick most banks won't tell, by which you'll have 0%. Imagine you have multiple credit cards, all from different banks. Each one has a balance, and all of them are charging high interest. Instead of trying to aggressively pay them off with high interest rate, you apply for a new credit card that offers a 0% interest on balance transfer for 18 months. Once approved, you move all your existing balances onto that new card. You usually pay a small transfer fee, but after that, you're not paying any interest for the next year and a half. What that really does is buy you time. You now have one payment and 18 months to actually pay down the principal. Every dollar you pay goes toward the balance, not interest. Now yes, applying for a new card can cause a small dip in your credit score, but if you keep making the minimum payment on time, your score typically recovers over time. And when that 0% period is about to end, you can repeat the process. Move the balance again, avoid interest again, and stay in control instead of letting the banks win. If used correctly, this isn't about avoiding responsibility. It's about using the system to pay off debt smarter, not harder. Use rewards only if you already have the cash. Chasing points while carrying a balance is like stepping over dollars to pick up pennies. Keep your utilization low. Using less than about 30% of your total limit helps maintain a healthier credit score and reduces stress if income temporarily drops. Set automatic reminders or auto-pay for at least the full statement amount to avoid late fees and penalty interest spikes. Treat 0% or low-interest balance transfer offers as emergency tools, not free money, and always have a plan to finish paying before the promotional period ends. When you understand these rules, the same card that once trapped you becomes a shield. You use it for security, fraud protection, and short-term convenience, while refusing to give away a single dollar in interest. Credit cards do not drag people into debt by force. They do it through design, incentives, and lack of awareness. The moment you see how the system works, how minimum payments, high interest, psychology, and penalties all fit together, you stop feeding it blindly. Knowledge does not cancel your debt overnight, but it does something even more powerful. It makes sure that from today forward, the system works for you, not the other way around.